The latest iteration of the BetaShares Economic Update webinar series. Today we'll be discussing Australia's economic outlook and the global macro outlook, and has Australia's luck run out? Joining me today, as always, will be our Chief Economist, David Bassanese, and we really look forward to having an engaging discussion with you. Before we begin, just wanted to reiterate, as always, that the information in this presentation is general in nature and doesn't take into account anyone's personal financial objectives. If you are looking for financial advice, please seek out the use of a financial advisor. And just some housekeeping before we start. We will, as always, keep a recording of the session, and that will be made available shortly after the conclusion of today's economic update. Please ask any question you'd like in the questions tab at the bottom of your screen. David will be more than happy to answer as many as possible in time today. And if we don't get to them, we will make every effort to get out an email with the other questions that have been asked and then pass them on as necessary to anyone that's asked a question today. And I wanted to just highlight some of the regular content that we're putting together in the market at this point in time. You'll see on our website the latest fund data, everything that's included in our funds, blogs, investment information, and a really handy resource to access white papers and different information that you may not be able to access anywhere else. So I would certainly highlight getting onto the website and checking that out, but also signing up to our regular insight pieces. I know many of you are familiar with David's economic update series, Bassanese Bites, which comes out every Monday, but there are some other resources that you may find interesting, and I certainly encourage you to have a look, as well as engaging with us on our social media feeds, and you can see the handles there of each one. And again, more than welcome any question or correspondence with us. Just a little bit of an update on BetaShares as a business. So at this point in time, the widest range of ETFs on the market with 78 and managing over $23 billion in funds under management at this point in time. I guess the two key things to learn about BetaShares are that we are, one, Australia's only founded and managed ETF provider. And what that gives you is, one, the fact that all of our funds are Australian domiciled, so no need for paperwork when investing. And two, because our portfolio management team's home-based, we're designing products that are relevant for the end investor in mind and taking in all the considerations that an Australian would need in a quality investment piece. But today, it's my great pleasure to welcome David Bassanese again for today's economic update. In terms of our team, David's responsible for developing economic insights and portfolio construction strategies within the business, and he chairs our investment committee. So it's now appropriate for me to hand over to David and welcome him today. I'll take you off mute and look forward to having a really good discussion. And I'll be back for some questions at the end.
Thanks very much, Blair, and great to be with you all for the last of our quarterly economic updates for what has been a tumultuous year again in financial markets and for the economy. So here's the agenda today. Go through the economic outlook, the macro policy situation with regard to interest rates, a quick comment on the budget, obviously that we just had in the last few weeks, what that means for bond markets, equity markets in terms of financial markets and some sort of it, and then drilling down a bit further within the equity market in terms of investment themes, where within equity markets at the moment seem most relatively attractive, at least. Just in terms of the economic outlook, let's start there. And again, just to emphasize, this is a point I've been making pretty much since all this talk about supply chain bottlenecks and inflation post-COVID has reared its head. And this is a chart of US real consumer spending, so allowing for inflation. It's like a measure of volumes. If you like, the red line there is spending on goods. The purple line is spending on services, and then the middle is goods and services. And so just to emphasize there that, COVID led to that short, sharp collapse in spending on goods due to the lockdowns. And then we had an enormous rebound in growth as the economy reopened. We had a lot of fiscal stimulus, a lot of income provided toward households to tidy them over. And it was really that surge in demand, particularly in goods initially, that's led to the inflationary problems that we're seeing around the world, where just supply chains weren't able to keep up with that strong rebound in demand. And if you look at it, US demand for goods at least has moderated over the course of this year, but it's still at a relatively high level compared to where it was prior to COVID. And meanwhile, we've had a pickup in services, so things like travel, tourism, hotels, restaurants, these sort of things have started to pick up, and that's caused pressure in the services sector. And so again, this is very important to emphasize this, because some people say, oh, we should just wait for the supply chain bottlenecks to ease, inflation will come down, why are we raising interest rates to deal with the supply problem? Well, the supply problems have come because of the initial demand problem, and so ultimately you need to slow demand to get inflation under control. At least that's how I've been seeing it. Now, coupled with that, you look at US wages growth, and I'm concentrating here on the US market. I'll talk about Australia in a minute, but again, as always with my presentations, you'll see I spend a lot of time on the US because they do drive global markets in large part. So where the US goes, we tend to follow more or less. So here's the situation with regard to US wages growth. Still very strong. Unemployment is at 3. It's actually just ticked up recently to 3.7%. Wages growth is, in an annual sense, a year-on-year growth has slowed, but it still remains pretty solid. And in fact, we got a payrolls number on Friday, a US employment number that had what's called average hourly earnings in that report, and it showed that had slowed down to around about 5.5% for production workers at least, which is still pretty high by long-run standards. So tight labour market in the US, a consequence of that strong rebound in the economy causing a solid wages growth, and also and this probably doesn't get as much attention as is warranted, and economists that talk about this get accused of being called being too left of centre or whatever, but the reality is that corporations in the United States have strong pricing power as well on the back of strong demand, and some of these companies are very big, strong, almost monopoly power if you think about some of the big tech companies. And so what you see there is different measures of corporate profit margins, which despite the surge in prices, or the surge in costs, we should say, they've been able to maintain their profit margins. And so what we've seen through this year so far is that corporate earnings have held up pretty well, which on one hand, yes, that's good news, corporate earnings are holding up. On the other hand, it means that the cost pressures they've been facing, they've been able to pass through higher prices, and hence why inflation has remained pretty sticky. And so it's not just workers demanding wage growth, it's just the fact that corporations are being able to pass through and increase, and in some cases increase prices above and beyond their increase in costs, actually increasing profit margins on the back of very strong consumer spending. And so this is like a red rag to central banks. You see strong pricing power, strong wages growth, a strong economy, inflation at generation highs. There's only one answer: is you've got to slow the economy to get inflation back under control. If you look at US inflation, again, this story, and really the story since we met a few months ago, hasn't changed. Inflation in the US has continued to remain pretty sticky. So I've got a couple of measures there. The consumer price index excluding food and energy. Now, if you had food and energy in there, inflation would be even higher. That's the headline measure. I don't strip it out because I think it's not important, but I strip it out just to focus on what economists look at as in terms of core inflation, because that's seen as a more stubborn, a more ongoing source of inflation, rather than just a surge in oil prices that affects headline inflation. So if we focus on core inflation, those numbers of late, the monthly numbers have been running at 0.5, 0.6, which has still been stubbornly high. And the story has been that, yes, some goods prices have come off, but service sector inflation remains sticky, which again shouldn't be surprising given what I was saying about pricing power by businesses and solid wages growth. So I guess you'd say that inflation in the US remains high, and that it has peaked. I mean, there's no question inflation has probably peaked, but the question is how fast, how quickly will it slow? Will it slow fast enough before it can get embedded into inflation expectations and then make it even harder to dampen down? at the moment, you've had to say that the progress on inflation has been fairly glacial in the United States. What about Australia? So again, a chart of retail spending. I mean, there's any number of charts I could show you on the Australian economy. I think retail spending is probably a good summary indicator of what's happening. The economy is still going along. And sorry, just to emphasize also, if I go back to this slide here, consumer spending. So one of the themes also that's been emerging is that, yes, central banks have been raising rates, but up until, as I speak, we've still seen resilience in the economy. So consumer spending in the US in large part remains pretty resilient. Housing sector has started to slow, so housing construction has slowed, house prices are starting to come off. But employment growth and consumer spending so far in the US has remained resilient to the ever increasing interest rates from the US Federal Reserve. And that's why bond yields have kept going higher. Markets have kept pricing in higher and higher levels at which central banks are raising rates, because they're trying to slow the economy, but so far at least the economy is not wanting to slow quickly. And if you look at the going forward to the Australian situation, it's similar. So you got retail spending very strong. Now we did get a reading last week where real retail spending in Australia for Q3 was actually pretty flat. If you look at that line there, the last reading there was only up 0.2%. So very tentative signs that consumer spending is starting to slow on the back of higher rates and falling house prices, which I'll touch on in a minute. But at the moment, so again, the economy has been doing very well. Employment growth's been good. Consumer spending's been good, and we've seen resilience so far to rate rises. And so what we're waiting for is for signs of the economy to slow down. And once that happens, as I've been saying, that will be the worst is over for bond markets, the sell-off in bond markets that we've been having, but not necessarily the worst over for equity markets, because then they've got to deal with the earnings downturn. Just looking at house prices in Australia. So as of October, house prices are continuing to fall. So we're looking at a peak to trough decline in nationally now of about almost 7%, 6.6%. In Sydney now it's hit double digits, so it's down 10%. And some interesting work that's been uncovered in terms of the RBA thinking on house prices. Their forecast now, you had to basically, journalists went through freedom of information requests to get this information from the Reserve Bank, but buried in their forecasting, notes is a forecast of something like an 11% decline in house prices nationally by mid-23. That's their current forecast. And they do point out that on a more pessimistic scenario, if households become pessimistic about the house price outlook, if you certainly change some of the assumptions in their models, you can then get up to a 20% decline in house prices by mid-24. So even the RBA are thinking, there's more downside to come on house prices. They think, so down 7, they think only 11, but most economists, and I would agree, have been counting on something around about a 10 to 15% decline in national house prices, which means we're probably only 1/3 to 1/2 of the way through the house price declines. And this, is part and parcel of the transmission mechanism of monetary policy. The RBA fully anticipated some house price weakness, because that in turn would hurt, dent consumer confidence, consumer wealth, and in turn help to slow consumer spending, which again we don't want to cause a recession, but we want consumer spending to slow to some extent, given that we ourselves also have a fairly high inflation rate in Australia. Now, I'll touch on the differences between Australia and the US on that in a minute, but we do want the economy to slow. The RBA is raising rates for that reason, but it's not counting on a recession, whereas I would argue in the US, particularly given the strength of wages growth, the Fed are more aggressive, and they do want to see a stronger slowdown in the economy and potentially a recession in the US to get it to break the back of inflation. Whereas the RBA here seems to be a little bit more open-minded about whether they need to, have a recession to get inflation down, as I'll get into here. And one of the key differences is, if you look at the bottom right slide, again, this story hasn't changed. Wages growth in Australia remains relatively benign compared to to the US. So that's the wage cost index, still running at an annual rate of under 3%. On a similar measure in the US, it's running at over 5%. And I've explained in the past, one of the reasons for that was the JobKeeper program. When we reopened, workers went back to their previous jobs pretty quickly and easily, whereas in the US, there's a lot of labour market dislocation, and it required businesses to basically compete amongst themselves to attract workers, which in turn caused wages to go up. And so that's part of the, so if you compare Australia with the US at the moment, yes, inflation, if you look at it, core inflation there, actually running at similar levels, but arguably more of our inflation is cost driven or supply side driven and global in nature, rather than in the US where more of it is reflecting very strong demand. So that's why our central bank is probably a little bit less gung-ho about raising interest rates. The other difference, of course, is that more of our home loans are variable rate versus fixed rate. You can see there's something like 80% of home loans in Australia are variable, whereas it's closer to only 20% or 15% for the US. And that means that as short-term interest rates go up and variable mortgage rates go up, then more households in Australia are directly affected by that. Their mortgage repayments go up compared to the case in the US where most are enjoying a fixed rate mortgage. And so, you know, if you fixed your rate a few years ago at a low rate, you're not directly affected as the Federal Reserve over there raises interest rates. And also housing is a bigger chunk of housing loans. It's a measure of like loans to income. Housing is more important to wealth and income, to wealth expectations in Australia than the US. So a given weakness of house prices should slow the economy a bit more relative to the case in the US. All of this is an argument to say why the RBA, A, probably doesn't need to slow the economy as much as the US, and B, for any given slowing that the Australia wants to achieve, it probably doesn't need to raise rates as aggressively as what the US would need to because of the greater sensitivity of households to short-term interest rates. Now, that doesn't mean we're out of the woods. I mean, the title of this webinar is, you know, can Australia avoid a recession? Now, what I've got here is the US unemployment rate in Australia and in the US, and those grey areas are US recession periods. The group in the US, the National Bureau of Economic Research, that date these to the month. And then I've got the the trough to peak increases in unemployment during the 1, 2, 3, 4, 5, 6 recessions since 1980. So you can see the recessions there. When the US has a recession, unemployment goes up by at least 2%, often you know 3 or so percent. You know, in 2008, obviously went up 5.6%. COVID, you know, went up 14%, albeit for a very short period. Now, as you can see there, in 4 of those US recessions, we had an increase in the unemployment rate ourselves of more than 1.5%. Now, I take an increase in Australia, we talk about a recession as 2 quarters negative growth. That's probably not a very meaningful measure because you can still have a substantial slowdown without necessarily 2 quarters of GDP growth being negative. A better measure is like the degree to which the unemployment rate goes up. And I would say that if the unemployment rate goes up by at least 1.5%, you could say we've gone into recession. Less than 1.5, it's a slowdown, but maybe not a recession. The arbitrary numbers, but I think 1.5, to my mind, it would be an indicator. Now, on that basis, we've had 4 recessions so in 6 of the last US recessions, we had 4 recessions. So just on that, you've got a 2/3 chance of having a recession if the US does. Now, some notable exceptions, of course, was during the dot-com bubble in 2001, our unemployment rate only went up 1.2%. But in the GFC, when the US had a pretty big slowdown in 07-08, even then our unemployment rate went up by about 2% over that period. So the old adage, you know, when the US sneezes, we catch cold. And so I don't think the concern for us is that I don't think it's going to be the RBA that drives the economy down. In fact, if anything, the fear of the US going into recession has the RBA thinking twice about how aggressively it will need to raise rates, because it does fear that, or it thinks that if the US slows, it's probably going to slow our economy, and the Fed will do some of the work in slowing our economy. So this is the challenge for Australia in 23. If the US, and again, as I think it will, back in June, I made the call that I think the US will need to go into recession, and the Fed will probably engineer it to break the back of inflation. And so as that happens, as that plays out, it is going to slow our economy. It's going to basically make businesses very nervous. Business confidence will decline. Businesses tend to scale back investment, cut back on employment, and it reverberates on the economy as well. So I think, you know, an increase in the unemployment rate in Australia of at least 1, possibly more. Even the budget papers and the RBA forecasts have the unemployment rate going up by around about 1% over the next couple of years. But I fear it could be a bit more than that, and it could be, you know, within a year, depending on how the US, when and if the US does go into recession. But that is the history of our relationship with the US there, just in terms of the unemployment rate. In terms of macro policy, now, just wanted to say, in terms of the Fed, I mean, this is the US Federal Reserve interest rate. You can see that there have been, there's 11 cycles there in which the Fed have been raising rates aggressively, and of those, 4 have been periods where the Fed it wasn't associated with a recession. So it is possible for the Fed to raise rates and not cause a recession, and that's what we call soft landings. But the question is not, again, as I've stressed in the past, the question is not, can the Fed avoid can the Fed achieve a soft landing? Can it avoid a recession? That's not the question. The question is, does the Fed think only a soft landing is necessary to get inflation down? Because if it concludes a soft landing is not enough, you need a recession, then that's when it will, you know, that's what it's debating at the moment. It's not, they're not necessarily trying to get a soft landing. They're just trying to see, they want to get inflation down, and they're bearing down on the economy. And if it takes a recession to do that, then so be it, is the way to think about it. And just on that, so if you look at those dots, so I've got the orange dots there are the periods of soft landing where the Fed's been raising rates. Again, 4 of the 11. And if you look at those periods, this is the US unemployment rate. All of those periods have been where the unemployment rate didn't go up. So a soft landing in the US is where the unemployment rate at least stops falling, maybe stabilizes, but certainly doesn't go up in any meaningful way. So to get a soft landing, now COVID, you say, well, why do I call COVID a soft landing? Well, because really you can't blame the Fed for that. That was lockdowns caused by, you know, COVID, which arrived basically a year after the Fed stopped raising rates. So I do attribute that to it I think were it not for COVID, you would have probably seen a soft landing over 2019, 2020. But that's what a soft landing looks like, is no material increase in the unemployment rate. But the problem is, again, with the US unemployment at 3.5%, wages growth running at such a strong level, the Fed's probably not going to be content with the unemployment just staying where it is, staying at 3.5%. They wanted to go up. And this is just another chart which I've shown in the past, is that every time the US unemployment rate has increased by at least 0.5%, and again, this is the increase in the unemployment rate from its rolling 12-monthly low. Every time it's gone up by 0.5%, it's usually has triggered the US going into recession, or it's been associated with the US going into recession. And every time that's happened, it's rarely stopped at 0.5%. So the idea that, you know, you can get a 0.5 to 1% increase in the unemployment rate, it just, so again, historically, just getting it up to 1 would probably means the economy will get enough negative momentum that will probably go higher than that. And trigger recession. So it's hard to fine tune these things. So just to summarize what all that means, a soft landing is where the Fed doesn't seek to increase the unemployment rate. At the moment, arguably, it does want to see the unemployment rate go up. It probably thinks it is too low. Now, once you make that decision, history suggests fine tuning that and getting only, you know, a 0.5 to 1% increase in the unemployment rate is very hard. Once it starts moving upwards, you usually break something and the economy can tumble into a recession. These are the current forecasts. So that at the moment, and again, what we've seen lately is that so this is the US Federal Reserve. So the market's now anticipating the Fed will raise rates to around about 5% by the middle of next year, which is again a significant increase in expectations over the course of this year. At the start of this year, markets were expecting the Fed to raise rates from 0, but they thought they'd only go to 1.5%. And so we've gone from an expectation of like no rate rises to initially only an increase to 1.5%, to now markets expecting a Fed funds rate to go up to 5%. So you can just see why we've had such a massive sell-off in the bond market this year, given that repricing. Now, my own forecasts suggest that Fed may not need to go that far, but it's it's pretty close. Even I think if you get another 50-point move in December and then another 50 points in the first half of next year, you'll basically, that's another full percent, and so that'll get you up to the top half of the 4% range. Now, just on that, we did see, there's been a lot of excitement about the Fed so-called pivoting. You may have seen it in the newspaper. So just to recall, the Fed in the last 4 Fed meetings, they have increased interest rates by 75 basis points each meeting. Now, at some point, they're going to have to scale that back. 75 points is a huge move. Usually they only move by 25. And so there's been a lot of excitement about them, signaling that they'll do a smaller move, only 50 in December. And so with the Fed meeting last week, we did have Powell come out, the chairman of the Fed, and say, look, we are probably going to scale back the size of the rate increases going forward, because we want to, rates are now higher than what they were, or we need to be a bit more gradual in moving them. But it doesn't mean we're going to stop raising rates. And if anything, the peak level of the rate, where we think it will be in the middle of next year, is probably higher than what we thought only a few months ago. So the Jerome Powell bent over backwards to tell markets not to get too excited about him scaling back the size of the rate rises. So we saw markets last week, sell off further, bond markets sell off and actually price in this Fed funds rate of 5%. Now, I personally think that the question is, what rate do you need to get the economy to slow materially? And at the moment, what we've seen is resilience. So the markets get pricing more and more and more. Now, so my, sense is that, another full 1% move by the Fed should be enough to slow the economy. But if it's not, they'll do more. What we do know is, one way or the other, the economy is going to slow. What we don't know is what interest rate it will take to achieve that slowdown. In Australia, the markets are also pricing in a cash rate around about 4%. I've got the RBA not raising rates that aggressively. I mean, a little bit less than that. So I've got 3 further 25-point moves by the RBA in December, February, and March. And then I think they'll pause. They may do more thereafter, but it will depend on a number of factors. But I think by that stage, we'll see enough signs of a slowdown in the US economy and enough signs of a slowdown in our own economy that they won't feel the need to do a lot more than that. Just quickly on the budget, look, the budget was pretty neutral for markets. It wasn't a big spending budget, but nor was it a draconian, slashing spending, raising taxes budget either. So broadly speaking, was pretty neutral for financial markets. The one good thing about it is we did get a further upgrade to revenue estimates from the higher iron ore prices, which have stayed higher for longer. And to their credit, the incoming government didn't spend all of that money. They actually let that money flow through to the bottom line and improve the budget position, as you can see on that first slide there. But the challenge is that going forward, they've made some more realistic assumptions about long-term economic growth in Australia, i.e. being a bit lower, raised the interest rate level that we'll need to service our debt. So the bottom line is that the budget outlook, going forward over the next decade is somewhat worse than we thought. And we're basically stuck with a structural budget deficit of about 2% of GDP. And someone at some time is going to have to redress that. And Treasurer Chalmers has talked tough about doing that, but he hasn't done anything about it yet. We'll see what he comes up with. My only problem is that it's going to get harder and harder to make big budget cuts as the economy slows. If ever there was a time to make big budget cuts to try to fix this structural budget deficit problem, it arguably would have been the first budget after an election at a time when the economy is strong. But he didn't, but he says he will, so we'll just have to see whether he does or not. That's really all I want to say on the budget. Just in terms of financial markets, just a chart of interest rates here. So the Australian interest rates there. So I've got the first slide there is the cash rate. The dotted line is the expected cash rate in 12 months' time. So that's what the markets are pricing in. And as you can see, that's gone from expecting no rate rises as recently as November last year, no rate rises over the following 12 months, to the market's now pricing in the cash rate getting up to 4%. And that in turn has been driving bond yields higher. Same sort of story in the US, bond yields higher. And the second slide there is the relative performance of Oz bond, is the bond composite index in Australia versus the bank bill index. So it's basically the performance of bonds versus cash. It's inverted, so if you look at it on the right-hand side there, so it's showing you that, no surprise here, as bond yields rise, bonds as an asset class underperform cash, and we've seen that, you know, through the course of this year. But you know, as bond yields basically start to level out, that period of bond underperformance relative to cash should also level out. Now, if you think that the RBA isn't going to raise rates beyond 4% or the Fed beyond 5%, then arguably bond yields are, you know, at a peak. And so the period of underperformance of bonds should be past us. That's my base case view. But as I said, central banks are trying to slow the economy. And so if the economy remains resilient in the face of these expected rate rises, they'll just do more. While I think this is the peak in bond yields, it is critical. It's contingent on the assumption that that will be enough to slow the economy, particularly the US economy. Aussie dollar I've got going lower. I think as the US, again, my forecast for this has panned out pretty well so far this year. I've been bearish on the Aussie, generally speaking, with the Fed being more aggressive than the Australia, iron ore prices coming off. And as the US does have a slowdown, I think there is more downside for the Aussie because that's going to be a negative for commodity prices. So the Aussie could break below 60 cents over the next 3 to 6 months if we do get that US recession kicking in. Problem for Wall Street, this is the chart of the S&P 500. So as of Friday's close last week, you can see the PE ratio for the market is at 16. So the two people sometimes say, oh, you know, the bad news is priced. Well, two problems with that is that, firstly, the PE ratio at 16 times earnings is not especially cheap. In a recession, that PE ratio can drop to 10 to 14. And so I think there's a risk of that dropping lower. But also, earnings expectations can get revised down. So if you look at the bottom left slide there of earnings, at the moment, the markets are expecting earnings for 23 to be significantly above earnings for 22. So that's a rolling monthly estimate of the level of earnings for companies in the S&P 500. So that's the black line for 2023. As you can see, it's well above the estimated level of earnings for 22. And 24 well above 23. So the market's still anticipating positive growth in earnings next year, which if we do get a recession is unlikely. In fact, that black line should fall below the grey line, i.e. you get negative earnings. So I don't think the markets unfortunately are priced for recession, and there is more risk in the short run more short run, let's say up until say the middle of next year, it's still going to be heavy treading because of that risk of the US having to go into recession. And similarly with the unemployment rate, as you can see here, this is a drawdown. So these are the declines of the US market in grey. And then the dotted line there is when you get a decline in the market of greater than 20%. And then the orange line is our market performance versus the US. And bottom line here is when the US has a bear market, i.e. greater than 20% decline, we tend to follow suit. And that's why, again, I focus a lot on the US market. I could analyze all the fundamentals you like about the Australian market, but in terms of broad direction, in terms of downside risk, you really got to focus on the US because that's what's going to hurt our market. So the good news is so far we haven't declined by as much as the US. As you can see, the US market at its lows has been down 25%. We're down not quite 20%. But again, I think there's still further downside risk because if you do get that US recession, the US market will go lower, and then commodity prices will go lower, which tends to particularly hurt the Australian market. I won't go through just to show these are what's happened in recessions in the past. 1990 was at So these are bear markets in the US, and the oranges are periods where the US did officially go into recession. So 1990 was an exception where the market only fell by 20%. It was a relatively mild recession. Earnings actually didn't fall in 1990, so it was only just the PE ratio falling, whereas the most other recessions, and COVID we can kind of exclude as well because it was really a very short, sharp downturn in the market. But if you look at the other recessions, 01, 08, in the 70s and the 80s, the downturns last up to a year or so, and you get around about a 30 to 50% sort of decline in the market. And you can see that's where we are today, 22, down about 25%, and the period of weakness has been, you know, around about 10 months or so. So in a historically speaking, if it is if it's something worse than the 1990 recession, then we've probably got a ways to go in terms of length and probably in terms of depth of the downturn. In terms of investment themes, so just wrapping up a couple of slides here. So growth versus value. So you can see that this is the relative performance of these parts of the market, and really the theme since the start of the interest rate increases late last year, has been the growth parts of the market, technology underperforming value, things like financials and energy in particular. So higher interest rates have hurt growth stocks and not value stocks, and I think that's going to remain an ongoing theme until such time as the economy does start to buckle. When that happens, you'll see the value parts of the market then start to underperform the growth parts of the market. But we're not there yet. And again, unfortunately for the growth parts of the market, they may stop underperforming, but they, in an outright sense, they may still remain under pressure. Cyclical areas are underperforming defensive areas. So defensive things like healthcare is a defensive area. Again, I'm talking about things that can hold up relatively better in a period of weakness. And just got some relative performances of themes there. You can see energy, you know, so global energy has really been a standout performer through the course of over the course of the past couple of years, with the strong rebound in energy prices, oil prices. Russia's invasion of Ukraine early last year has added further upward pressure to both oil and gas prices. So that's really supported global energy producers. And you can see that the NASDAQ and quality have tended to underperform. Healthcare's done pretty well as well because of its defensive qualities. Gold, not so well. So gold hasn't benefited in this environment, which I attribute to the fact that central banks have been so aggressive in saying they are going to tackle inflation. So markets aren't pricing in high inflation lasting beyond the next 1 or 2 years, and hence gold prices haven't been able to benefit all that much. Look, that's pretty much it. There's just some different exposures in terms of our ETFs there, which I usually just quickly go through. But so the growth there, you know, the things that have been hurt with this particularly so far have been global quality, the technology areas. Now, I believe that we will get back to a low inflation world, you know, once we get through this current bear market. And so that, keep in mind those sort of technology quality areas, because I think those are going to be the things that do bounce back when we get through to the other side and the economic and the renewed, you know, the next bull market phase. But we're not quite there yet. And the value areas, you know, fuel is our, if you do like the energy sector, fuel, FUEL, is our global energy exposure, which is, again, has been doing pretty well of late, given the strength of, and the ongoing, you know, I haven't mentioned China, I haven't mentioned Russia, but, you know, the ongoing war in the Ukraine, it's a ongoing war of attrition. There doesn't seem to be any solution there, and that's going to keep upward pressure on prices, unfortunately, gas and oil. I'll leave it there. Obviously sorry, I should just to quickly point out, I mean, if there's any silver lining out of all of this, is that as we do get that economic slowdown and bond yields start to peak, you can start to lock in pretty good interest income returns on the defensive parts of your portfolio. So things like CRED is our long duration corporate bond ETF, OZBD is our composite bond. It's a combination of government and corporate bonds. AGVT is pure government bond exposure. So these are fixed income exposures which are now offering pretty attractive interest rates. But we're just waiting for that sign of a slowdown to come through so we can be confident that the worst is over in terms of the bond market underperformance that we've seen so far this year. I will leave it there. Things to consider, yeah, obviously as Blair pointed out, so obviously seek advice. All of our funds have product disclosure statements associated with them. Obviously this has just been general information, not personal advice in any way.
Well said, David. Thanks very much. And that was a really good overview, I think, of the state of play of where we're at, both at home and internationally. There's a heap of questions coming through. I'm just looking at a few coming through now, but we'll get onto them in a second. So would encourage everyone, just if there is a question, now's the time to ask. More than happy to cover off on them. Dave, maybe a quick one for you. One that's come through is, or there's been a couple come through on the topic, but just in terms of gold, what event might re-rate gold, and does it continue to have a place in pre-retirement and retirement portfolios?
Yeah, so gold, what we call, basically gold. If central banks had said, look, we know inflation's high, but we don't want to. We're not going to risk a recession to get inflation down. We hope it'll come down eventually. So like a rerun of the 70s, where we had inflation start to break out. Central banks made furtive attempts to bring inflation down, but look, we still got recessions through the course of the 70s because of the oil price shocks. But we never really broke the back of inflation. So if inflation remains, higher for longer, central banks basically blink and sort of decide, we don't want to send the economy down too far, then that's where gold could probably do well. But again, the opportunity for it to do well so far has been undermined by the hawkishness of central banks this year and their steadfast determination so far at least to raise rates to keep a lid on inflation. Now, where does it play in a portfolio? Look, the beauty of gold is that look, it has a certain intrinsic value, of course. It's generally uncorrelated in terms of performances with gold, equities and bonds. So it hasn't done as badly as some other things at the moment. So as a diversifying asset within a portfolio, it makes some sense. So a small allocation of gold as a source of diversification and as a hedge against an inflation, central banks not wanting to tackle inflation maybe makes some sense.
Thanks, Dave. The other one that's coming through from quite a few people is just with respect to the US midterms. Not sure if you have a view on whether Republicans sweep the House or there is a bit of gridlock there, and the permutations that has for the market. Any commentary on that?
Yeah, so we've got to take the polls suggest that the Republicans are going to do very well. Potentially take both houses, the Senate and the lower house, at least take the lower house back. The Senate a little bit more up in the air. Now, so that's what the polls suggest. Of course, it does depend on the turnout. The big issue with the Democrats is, people like Barack Obama have been pointing out, if Democrats turn out, in strong numbers, then they can win. So it really just depends on what the polls don't capture is that turnout, unfortunately. So it is. So if you had to bet on it, you'd think the Republicans are going to at least take the House of Reps. And really, for gridlock, that's probably all they need. You just need one house. But if they take both, you're going to get gridlock. Now, again, rightly or wrongly, markets tend to like gridlock because they don't like too much happening out of Washington. So at least as a short-term reprieve, if they do win, then you might see a short-run bounce in the markets. In fact, equities are up overnight, and one of the reasons is that in anticipation of a Republican win in the midterm elections. So we'll see how that plays out. But that's a state of play. And and again, in terms of, look, I think if anything, it's just going to be a short-term bounce. I mean, I don't think it's going to change the course for interest rates of the economy all that much, but it's worth maybe a short-term bounce in the markets on confirmation that there'll be no more tax increases or big spending, major policy changes, because anything Biden would propose won't get through, unfortunately.
Yeah, thanks for that question coming through. A good one on the midterms. Dave, I know we touched on US dollar and where that could go, but maybe just in a couple of sentences, your outcome for the dollar over, say, the next 3 months, maybe to the end of the year, and then maybe longer term.
Yeah, I'm still a US dollar bull. The Fed are still aggressive in raising rates. At the moment, talking about raising rates to 5%. The economy remains pretty resilient, so they do need to get those rate rises up to help slow the economy. And the other thing about the US dollar, so at the moment, the US dollar is being driven higher by relative interest rates. More aggressive US interest rate increases, relative strength in the US economy. Now, when and if the US tips into recession and we get a global slowdown, the US dollar suddenly funnily enough, the US dollar may actually remain strong because then it becomes a safe haven asset. So it may remain strong, but the reasons for that strength change. And that's what I would anticipate, particularly against the Australian dollar. So anytime you have a global downturn, a global recession, it's not an environment where the Aussie dollar is going to rally. So my outlook is for continued strength in the US dollar. And continued, not in a straight line, but continued weakness of the Aussie dollar.
Great. A couple coming through, I'm going to try and amalgamate, but maybe just some commentary on commodities, with being mindful of China potentially reopening and what impact that may have on some of the commodities market.
Yeah.
Maybe we'll start with that.
Actually, Blair, before again, we are an ETF provider, so I should make mention of the fact that we do have some currency ETFs. So if you are a believer of further US Aussie dollar weakness, US dollar strength, there are ETFs that we offer that can you can go long the US dollar versus the Australian dollar. Similarly, if you think the Aussie dollar is getting cheap around these levels, you can, and you want to start to accumulate a long-term position in the Aussie as versus the US dollar, there are ETFs as well. So it'd be remiss of me not to point out those investment opportunities, but definitely visit our website and have a look at those if you are interested in taking a currency position. On commodities.
It's a good point, Sorry. Dave. And the ticker codes for those, USD is one, Yank is another, and AUDS is the third in the Aussie US currency component of our suite. So Dave, the other question was commodities, building in China there, and your view, and then maybe further to that, just some sort of inflation hedges and the way people could play that.
Yeah, so China is a very uncertain situation at the moment. Like there was, the hope was that when the president was reappointed for another term, that they would then, ditch the zero COVID strategy, try to reopen up the economy, basically learn to live with COVID. I mean, sometimes they've got to pull the Band-Aid off there and let COVID, seep through the community, but they. And there was some excitement on Friday that they might announce something like that. And you did see a bounce in commodity stocks, a bounce in the Aussie dollar. And then over the weekend, those rumours were quashed. So we'll have to see how that plays out. But obviously, just given that market reaction, I think there is a chance of funnily enough, even though with the challenging situation in the US, China, given it's been so beaten down, and it's also because of this zero COVID strategy and the dealing with the property market fallout. If they flick the switch to learning to live with COVID, re-stimulating infrastructure projects, you may see the Chinese market do actually rally even in the face of a weakness of the US market. The correlation between China and the US is not very high, so that's quite conceivable. So a bit like one scenario here is a bit like the GFC, where You did get a US downturn, a pretty bad recession, but China flicked the switch to massive fiscal stimulus. Commodity prices boomed. Aussie, we still had a downturn, but we didn't have a bad a downturn as might have otherwise been the case. So that is something to watch. But I mean, it's just very hard to read the tea leaves in China at the moment. What I do know is, there's no easy way out of COVID. As we all know, they have no herd immunity. They don't have herd immunity. Vaccination rates amongst the elderly in China are still relatively low. But you can't lock down people forever. And as soon as you let them out, COVID is going to run rampant through the economy. And that's just something they are they don't want to face, but unfortunately they're going to have to face. And so we'll just see how they manage to deal with that.
And then
again, I mentioned fuel as an inflation hedge. I mean, look, our own resource, QRE, Australian Resources. If you like the resource, if you want to play the China rebound theme through resources, the QRE is the code there. Now, again, this is another one. Asia, ASIA, is Asia Technology. Now, you may be horrified at this suggestion because it's been so beaten up because of technology having been beaten up and the woes that have been befallen China over the past year. But if China does start to focus on the economy again, then that one could be poised for a substantial turnaround as well. That is ASIA. That's the Asia technology, not just China, but 50% of it is Chinese technology stocks. But you've got some Taiwanese, Korean stocks in there as well. But that's another one on that front. Yeah, so just some ideas there.
Yeah, last couple coming through. One on one of our newer funds, and just I guess its base case in the current market, Royal and royalties, investing in royalties. Any commentary on that?
Yeah, so this is an interesting one. So this is a fund that invests in companies that collect streams of income from royalties, be it mining royalties, be it music royalties. And so what it is a relatively dependable income stream that these companies offer. So as a source of relatively dependable, less economically sensitive revenue, that's something to bear in mind. So that's one we've recently launched. So again, it's another source of diversified income. But that's probably all I can really say on that point.
No, fair enough, Dave. And look, the last one just relates to that cash and fixed income slide. And I'm not sure if we can go back to that because I think we might have just moved too quickly for some people. There's a request to go back to it. But certainly in terms of the ASX listed ETFs that you can get exposure to cash, the investment there from BetaShares is AAA. But there is also a range of fixed income, whether you want floating or fixed, within different markets. So we'd definitely encourage you to check out our website for any further information on that. But some ticker codes there in front of you. But in terms of the content and formalities for today, that's it. Thank you very much, David, for your time and your insights. If there is any further questions, please interact with us via our social media channels, and we will get back to you on the other questions that we have not covered today in any detail. But that's all we have time for. Thank you very much and enjoy your day.